Now, consumers battled rising inflation and higher interest rates this year, pushing up healthcare costs and repayments on property and cars. Newzroom Afrika's Ntokozo Khumalo looks at the year that was.
Many households suffered financially this year. While it's easy to point the finger at the Reserve Bank for raising interest rates, Governor Khumalo says the real culprit is inflation.
That you seem to be thinking that the purpose of policy is to target rates. We don't target interest rates. We target inflation. So if you want to know where interest rates are going, look at where inflation is going. For the lower the inflation, the lower the interest rates you would have. And if inflation is...
By July, the print was sitting at 4.7% before climbing to 4.8% in August and jumping to 5.4% in September. In October, consumer inflation price edged higher again to 5.9% before settling at 5.5% in November. To ensure that the Monetary Policy Committee is not swayed by volatile items when considering factors for the interest rate decisions, food and fuel are stripped out to get to core inflation. Khumalo says there's some improvement, but that the SARB remains cautious.
Measure the inflationary pressures. We try and strip out the volatile items like food and fuel so that we can arrive at what we call core inflation. Our forecast for core inflation has actually shown that core inflation has declined this year and that it will remain around the midpoint of the inflation target range. That is one measure that says to us that the inflationary pressures have not quite spread from the three volatile items being food, fuel, and electricity. However, bear in mind that even the pressures in those volatile items could spread into the core and thus lead to a resurgence of inflation, and it is important for us.
Associate Professor in Finance and Financial Planning at the University of Canberra, Bomikazi Zeka says the rising inflation and interest rates have caused consumers severe financial distress over the year.
Cost of living coupled with hikes in interest rates becomes financially stressful because now you're put in a position where you have to pay more money for the same basket of goods. And a lot of South Africans can attest to the fact that salaries aren't keeping up with inflation. And so in many cases, it causes financial anxiety.
Property owners felt the pinch early on in the year through increasing bond and vehicle repayments that sometimes more than doubled their financial obligations.
A homeowner that bought a property of 2 million rand, for example, when they bought in a very favorable interest rate 2 years ago, so just after COVID or during COVID, their bond repayments would have been approximately about 15,000 rand a month. Now we've had all the increases, and that same bond is now, 25,000 rand a month. So you're talking about a 10,000 rand a month increase, which is a challenge.
The DOI adds that it also makes no financial sense for property owners to try scale down by selling their properties if they've owned the assets for 5 years or less.
If that homeowner now wants to sell their property and get out of that property, it's very difficult because they bought for, let's say, 2 million and now they had to pay bond costs and transfer fees. So you're looking at between 160 to 180,000 rand bond costs and transfer fees, which is cash. Financial institutions don't finance that. So what happens is I have to sell now in a higher interest rate market and I have to try and recuperate the money.
The picture was similar for car owners, and it made no difference what car brand or make it was. The interest rates saw repayments steadily rise over the year. Zeka says many consumers turn to debt to fill the deepening financial hole to meet their obligations, often without considering the long-term effects, including the interest repayments on the loan itself.
When interest rates go up or in times of financial difficulty, the risk of default also then increases. And if this happens, it only now spells out bad news for your credit rating, which could ultimately jeopardize your ability to acquire a loan in the future when the time comes.
Another financial pressure that consumers must prepare themselves for, according to Zeka, is healthcare inflation, which has also steadily increased this year. Some of the most significant medical aids in the country, such as Momentum Health, have raised their prices by up to 9% on the back of rising input costs. ProfMed CEO Craig Cormery says these poses significant challenges for the medical schemes and their members.
We note that healthcare inflation outstrips consumer price inflation by probably 2 or 3%, and there's a few really key reasons on why that happens every year.
These include advancements in technology and medicine, dollar-based high-cost equipment, immigration of skilled medical staff, burden of diseases driven by poor lifestyle choices. It's projected that by 2034, the cost of the lowest level plan medical aid could be as high as 2,600 per month per member, compared to 1,000 Rand today. MedScheme Health actuary Sarah Bennett shares the same sentiments, saying that skyrocketing healthcare costs are a global phenomenon. Bennett has noted the rapid growth of medical insurance due to affordability.
The medical insurance is an option, but you must remember that the coverage is not as comprehensive. And equally for any low-cost benefit option that may be introduced, it would need to be exempted from the prescribement benefits, so it wouldn't provide as comprehensive coverage. So I would just advise consumers to purchase wisely and just make sure that you know what is covered and what is not covered.
Zega says while all these compounding financial stresses will likely intensify in 2024 before they get better, returning to the basics of budgeting can go a long way.
And so clearly demarcating how much you're going to account in your budget for your savings can make a huge difference in the long run. And really we're playing the long game here, that the situation is not going to remedy itself in the short term. So putting away your savings first and then spending what you have after saving is a key tactic that can make a difference in your finances and in your household's budgeting in the long run. Have a look also at consolidating your financial products and use that to your advantage. For instance, you can negotiate the increase in your annual premiums for your insurance. And if you have multiple insured products under the same insurer, have a look at speaking to the rep to see if you can negotiate or even stall the increase in your premiums. A lot of people don't know you can actually negotiate your bank fees. So speak to your banker or someone that works in the banking institution that you give your business to see how they can consolidate the fees so you're paying less fees. And then finally, I want to mention that it's so important to play the long game. Think about the trade-off you have between your short-term savings and your long-term savings. Now, it's good to have money in your savings account, but you also want to be cautious about having too much money in your short-term savings because idle doesn't earn returns.
The SARB also warned that it is on standby to act should inflation continue to remain stubborn, eating away at households' incomes.
Target sustainably in 2025. There might be months during 2024 where inflation could actually be at 4.5. So when that happens, don't get excited and say that, so is it now time to do something opposite? Understand that we do have an idea of what the outcome for each of the months would be, but for us, what is important is what is the momentum of the inflation. Is it a sustained momentum towards the target or away from the target? And if it is a sustained momentum away from the target, we stand ready to deploy our tools to bring it back.
Statistics South Africa will release December's CPI print in January next year, and the SARB's NPC is due to meet in the first quarter of the year. For Newzroom Afrika, I'm Ntokozo Khumalo in Johannesburg.